Good morning, everybody. Hope you all had a good weekend. I'm looking forward to the week ahead. I know that I am. So, if we look at last week's market results, we'll see for the second week in a row, we've seen some gains across most of the major indices. We had the Dow up 2.2%, the Nasdaq up 2.7%, the FTSE up 1.6%, the bundle of four was up 2.3%. The Nikkei 5.1%, Shanghai 3.9%, and the DAX in Germany was up 3.3%. So all the major indices saw the markets going up last week. And in fact, when you look at the year-to-date results now, US is only marginally down at about 2% since the beginning of the year, and the FTSE is actually up on the year, albeit by less than 1%. But considering all of the panic monkeys out there in January thinking about, another 2008 and all doom and gloom, certainly that's not playing true as we speak here. On the currency side of things, we're still seeing a strong US dollar, although we did see sterling make 2.6% up against the US dollar during trading last week. When it comes to the US dollar and sterling, I've always followed a very simple philosophy insofar as I think if you're at 175 sterling against the dollar, you should be buying dollars with your sterling. If it falls to 145, you should be buying sterling with your dollars. And by adapting that philosophy and that strategy over the years, hasn't done too bad. Most of my clients tend to be US dollar or sterling based, and I appreciate you can throw the euro in there and make some gains by buying and selling those currencies as well. But sticking to a fairly simple strategy like that usually does okay, and especially in these current interest rate environments where you're getting nothing in the bank for your cash. If you are wanting to hold cash, and of course everybody needs to hold a little bit of cash, then by looking at flipping those occasionally, I think you can end up making a little bit of money and spreading your risk. We saw the euro and the Japanese yen flat for the week. Just going back to the stock side of things, and obviously talking about the markets and where they are, and them not being as bad as many people may envisage out there. If some of you may recall, or if you look back at my my previous YouTube updates, around about the end of last year, I started talking about getting involved in a mining fund. Now, of course, mining is usually a sign that economies are getting healthier because there's more construction and development going on, and despite the issues in China recently, I think the story is that they are still looking to grow, albeit at a slightly lesser rate than they had anticipated previously. And just a case in point, the mining issue. Two of the largest mining companies out there are Glencore and Anglo American. And if you look at those companies' results this year, their year to date, you've got Anglo American making over 96%. You would have doubled your money on Anglo had you bought some shares at the start of the year. And Glencore, which I think is an even larger, slightly safer bet than Anglo American, you would have made 75%. So, there's opportunities out there, and I'm not saying you should be in these sort of stocks because obviously there is volatility that exists. Previous to these results, we did see people lose a lot of money in both of these two shares, but you've still got your steady eddies out there, the Unilevers, once again, poster boy stock, up on the year, about 1.5%, but it's paying a 3% dividend, and again, this is a lot better than what you're going to get in any bank in the world. So if we look at the sports this weekend, we had Leicester continue to remain top of the league, and it looks more and more likely that they may go all the way, especially with Spurs and Arsenal not taking advantage and gaining points on each other. I was talking the other day about how there may be people out there that have bet on it and what the bookies would pay. In fact, I read a story that the bookies did pay out at 1,000 to 1 to one chap who had £20 on Leicester at the beginning of the year. 5,000 was the 5,000 to 1 was the odds at the start of the year. But I think that gentleman did the right thing by taking his 20 grand at a £20 bet. So a couple of things to talk about just to finish is the quotes. And again, we had the Oracle of Omaha, Mr. Warren Buffett, speaking last week on CNBC. and you could have quoted 50 of his sayings during that 3-4 hour interview that he gave to CNBC. But one he mentioned again was focusing on quotations is a terrible way to invest. Again, it's all about the company. It's all about the company doing good things, good management, good structure, long term, and you won't go far wrong. As far as retirement goes, I was reading something the other day. In fact, I've put on my LinkedIn page if you want to take a look. Some scary facts about retirement. If you want a 30-year retirement and you want to have $5,000 a month, and this is based on a 6% annualized return and 2% inflation, then you need to have a pot waiting for you of over $1 million. Now, I know it sounds quite a scary predicament to get yourself $1 million, but if you get in there early enough, 15, 20 years, doesn't mean to be rocket science. It can be done. We build it up slowly. We make sure that those later years in your life are comfortable, where the last thing in the world you need to worry about is money. So bear it in mind. Please get in touch. You know where I am. Easy to find. Have a good week. Cheers.